Hi everybody, welcome to this webinar. I'm Gautam Mitra. I'm a technology addict, so even at 78, I cannot stay away from exciting new technologies. Today, we are pleased to host a webinar from Bloomberg Research. As you know, Bloomberg is the leader in content in the domain of financial analytics. And we have with us one of their talented researchers, Mr. Arun Varma. Arun has a very distinguished career. He is an IIT graduate and he has a PhD from Cornell University in the domain of computer science and applied math. Since then, Arun has been in the researching in the domain of finance, and he is a lead researcher with Bloomberg. So without final ado, I hand over to him. He's going to talk about extracting embedded alpha in social and news data using statistical arbitrage and machine learning. Over to you, Arun.
Thank you, Professor Mitra. Thanks for the kind introduction. It's nice to have all of you attending this webinar. The topic of today is extracting sentiment and alpha signals from social and news data. But before we dive into that topic, I also wanted to use the opportunity to share some of the other areas Bloomberg has been working on in the quant and machine learning space. So let me see if my controls are working. Yeah, there we go. So, I guess most of you are familiar with our company. One of the things I wanted to emphasize here was the last point there, which is about 5,000 strong capacity for engineers and programmers, about 300 of which are, machine learning scientists and quants in Bloomberg. So at our heart, we are very much like a technology/scientific company, so to speak. We are contributing a lot to open source projects lately. So we're trying to really have a lot of leadership in technology/quant and ML space. So very much like it's sort of a Silicon Valley software company rather than a financial services as such. Let me go to the next slide here. So to start out with some of the main applications of natural language processing. So yeah, as you guys probably appreciate, natural language processing and machine learning are sort of both used, in finance as well as many other disciplines. They're really the two cornerstones of the next sort of AI frontier in these emerging technologies. So Bloomberg obviously is a big news organization, and so our machine learning, our AI effort really started more from the NLP side. So as we know, we have information arriving in terms of the news stories or tweets, company releases, and so on. And so this needs to be digested using real-time, smart natural language processing algorithms. So we are extracting entities from these textual data. We are automatically tagging people and companies and topics. We're doing sentiment analysis. Also, some of the more advanced use cases around novelty detection of maybe a new topic has just broken out, maybe in an earthquake somewhere, for example. So these kinds of things need to be actually presented as a scientific problem, and they can be solved using NLP and machine learning methods. We are converting these textual data into something structured that our clients can consume. We extract events from it. We extract data from our textual stories, and examples of that are, even generating some automated news stories based on data. So we have a new initiative for data-driven news, for example, which essentially is listening on the multidimensional data in the markets and trying to sort of figure out anomalies, patterns forming in those data that are relevant for our hedge fund clients or our quantitative analysts who can further sort of use those events, data-driven events, to model potentially a portfolio construction method. We are also looking at a lot of the textual data from emails and IB chat to help extract prices and patterns that we can present back to our users as information. Machine learning itself is being used in a variety of disciplines at Bloomberg. These are just some of the examples. Going from volatility modeling to calibration tasks. A lot of predictive analytics here. One of the highlighted tasks here is around factor investing, which I will give you a little taste of in some of the upcoming slides before we dive into the topic for today. But as you can appreciate, finance is a very rich field for machine learning applications, and there's definitely a lot of good progress that not just Bloomberg but industry in general has been making in these areas. To give you sort of a more higher level context around the quantitative idea generation, before we look into specifically the news and social side, in general, you can look at quantitative idea generation aspect as either looking at certain events and studying data around the events. So we call them event studies. Or if you are like a quantum mental player, you will appreciate studying factors and factor strategies. So they are kind of the two sides of the same coin. Events are essentially defined using some sort of financial or company specific or economic events, which are sort of physical events, possibly earnings, for example, or economic release. Those are physical events, but they can also be data-driven events. So you can define drivers and rules for those drivers that can help trigger an event. And for quants, the workflow there is to really help with backtesting and optimization of those events. So you are looking at historical analysis of those events and seeing what transpired in the past when similar events occurred. And finally, you can also optimize the definition of the event as well as possibly the output of the event, in terms of what horizon is the most ideal holding period for a trading strategy for those kind of events. Similarly, factor strategies are sort of more apply at a higher level. So they are essentially looking at a big universe of underlyings at the same time. Events are sort of focused on an underlying at a time because they are specific to a specific name or a specific asset, specific sector maybe. But factor strategies go beyond a single name, and they are applicable at a universe of underlyings at the same time. So you are looking at, for example, a factor which applies across, say, Russell 3000. So you are studying for example, value versus growth strategies, and you're looking at for the 3,000 stocks in the Russell 3000, has value outperformed growth, or has size kept up with the value factor, and how are maybe the momentum factors or or volatility factors playing. So those are really cross-sectional, and in those kinds of analysis, you're looking at analysis which are more like quintile cuts, and looking at Sharpe ratio of these quintile portfolios, and finally going into portfolio optimization framework, where you're trying to find optimal combinations of factors which lead to the best Sharpe ratio. But there, as I said, these are really the two sides of the same coin. Event, you can see that a special case of a factor. It's discrete versus continuous distinction, if you will. But these are both important for quants to analyze. Events can be of many types, as I mentioned earlier. We got technical events. There are actually analyst events or company events, and for more recently, quants are looking into data-driven events or days like this events, which are essentially mining for patterns which are most related to current market information. And just as sort of a best practice that quants need to follow for studying these kind of events, we always warn our users that you need a lot of scientific rigor to help understand values in these events and not be susceptible to various biases and overfitting concerns. So, for example, you want to make sure the data is the true point in time, and there's no sort of wrong tags in terms of dates and time. So we should not have any sort of look ahead bias in our data. That's very crucial. Similarly, survivorship bias and membership biases are very crucial, because we may be looking at members of an index when we are studying for quantitative factors, and it's important to reconstitute the members of the universe as of the historical backtest time, and not just look at the members today, because there is a bias in those members which have survived over time. So these survivorship and membership biases have to be properly accounted for. If you just look at the companies existing today or companies which are members of the index today, they have survived only because they've done well, and so there's a bias in there. There's a few more concerns around like transaction cost analysis, which is an important piece, as well as data snooping issues. Often you will try to find examples which you think are statistically significant, but that might be a sheer luck, because you're testing data in too many ways, and you're bound to find something if you poke around the data in multiple cuts. So, for example, an example that you can use to motivate that is if you have one of the fund managers in a selection of 32, which happens to return 5 consecutive years of good performance, is that really a skill on part of that manager, or is it really just luck? Because if you believe in random walks, that there will be one such manager or one such fund among 32 which will have five consecutive positive performances. So those things need to be adjusted for, especially when we're looking into quant and machine learning models, which are very adept at learning these biases and errors, and we want to make sure we are controlling for these things in the proper way. So Bloomberg has been looking into lots of these areas, and recently expanding into a lot of alternative data as well. So we're talking about the news and social today, but we have a lot more content in various areas. For example, supply chain or knowledge graph. Also ESG, which is a really hot topic among the investors who want to do the right thing, invest in sort of socially responsible companies. Obviously, more traditional technicals and volatility and credit stress data is really important for factor studies, as well as the last point there, which is more around alternative data with retail footfalls or credit card or loans data and so on. Just to give you a taste of one of these projects, I'll tell you about a project that we did using machine learning for smart beta factor rotation or factor timing. So as many of you appreciate, there are multiple factors that are known as risk premium factors, which sort of describe how the equities co-move with each other over time. So these are really drivers of risk and return. And Pharma French came up with first a 3-factor model and then a 5-factor model, which show these popular factors which are known to carry risk premium. But even these factors are not performing well throughout large periods of history. So these factors, you will find they have performance which is highly time dependent and cyclical. So you'll find some factors are performing better maybe in bullish phases of the market. Others are outperforming in the bearish or defensive settings. So this can be framed as a sort of a typical machine learning problem where you want to sort of map out the current market conditions, which are coded from multiple variables that I'll show you in the next slide. So we go from the mapping of these market conditions or variables to a selection or a prediction of which factor strategy will outperform in the next period. So this is the way we set it up here. The inputs are some sort of market data and macro variables. So we're looking at the performance of the index itself over the past period. We're looking at volatility levels. We're looking at maybe the shape of the yield curve, inflation values, maybe oil prices, things like that are, at the macro level, explanatory of how the market conditions evolve, and we want to find out among the popular factors, which factor performs the best for the next period. And we use one of the popular machine learning algorithms, basically random forest, but with gradient boosting on top of it to optimize the decision trees. And this is a result of that study. We find that on the far right we have the 2 machine learning based methods, and on the left side we have the typical market factors, or the risk premium factors. And you will see that if you look at the Sharpe ratio one, the third row, the machine learning models, which is the optimal combination of all the factors, is outperforming any of the single factors directly. So if you were to just believe in just the value factor or just the momentum factor, you will not get a good performance. But it actually pays to cycle through or rotate through these factors over time. And the challenge really is to go from the machine learning model into something which is more interpretable. I think that's one of the challenges in AI right now, is to come up with in models which are more explanatory or intuitive. So at Bloomberg we also have Bloomberg, our in-house analysts for Bloomberg Intelligence, and they are actually looking at it from much more sort of market perspective of how these regimes can be intuitively described. So now we're looking to sort of marrying the fundamental approach with the quant approach, and that's sort of the hallmark of the quantamental approach, is to sort of link the knowledge of economic fundamentals and market conditions into forming the market regime, and also teasing that out with what our machine learning model learned for the same problem, and making that quantamental connection. So without further ado, on the broad setting, we'll dive into the sentiment topic from the news and social factors. To motivate that, I start out with this quote from Alan Greenspan. About 10 years ago, he said that we don't need big mathematical models, only only if you had access to the market sentiment or the sentiment of all the players in the market. So this shows you sort of how valuable as a factor the investor sentiment is. And to set this up further in Bloomberg context, Bloomberg is trying to react very quickly to the market news. So, like in this particular case, there was a SEC announcement, and within 20 minutes you saw like a big crash in the market, about 12%. And it was important for Bloomberg headline to come early in the process. As you can see, we were able to break out a headline about a minute after the announcement, ahead of a New York Times story. And this is kind of the environment we are operating in, where we want to do real-time, story generation, real-time sentiment analysis, real-time topic discovery. It's all key to Bloomberg product. Here's a couple of screenshots from the Bloomberg sentiment data on the terminal. You can see, the cuts on the most positive sentiment companies and the most negative sentiment companies at any given time during the day. And then you can also look at the stories which contribute to that sentiment as well. So you'll see not just the headline, but the full story, as well as other market data to give you the full context behind this information. So that was sort of on the terminal side. Bloomberg also has an enterprise level newsfeed data, which carries a lot of that information. So, if you get in touch with us afterwards via email, we can give you more information and put you in touch with the product manager. But we are putting out news data on a real-time wire, and it's very, very precise in terms of accuracy. We push it out, with a millisecond timestamp. As soon as the story breaks out, it's available to, as a black box to be integrated with your enterprise systems. And these are the kind of information that is flowing through that feed. So, we put all the content through, including the full story, and all the extractions that we do using machine learning are included in that news feed. So now, this is sort of another use case, sort of motivating the need for a real-time delivery of news data. In this chart, if you look at the x-axis with the timestamps, we're talking really in sort of sub-second time frame here. How important is it for us to put out information in milliseconds after it's available to us? So our machine learning algorithms are very efficient. We are able to crank out the various sort of topics, tags, entities, sentiments in real time from the news or textual data. So with that, I'll start with the technical part of the presentation. I'll go into some of the topics related to extracting sentiment. So some of the machinery behind in terms of our machine learning methods, how we build those algorithms which extract the sentiment from textual data, and then we will dive into how we prove that these data has value in terms of trading strategies, and give you some sort of a few sort of use cases or analysis that you will find useful in terms of looking at the information in various cuts, maybe in terms of size and sector. So to start off with, the sentiment analysis problem is a very sort of typical supervised learning problem. So the very first stage, of course, is for us to capture as much training data as possible. So the training data in our case is essentially human experts assigning one of the three labels to the training, to the stories. So we are looking to classify every story into either a positive, negative, or a neutral story, and we have a large training set. With the help of in-house experts, we have a big news organization. So we have journalists and we have industry experts and so on who can help us with generation of this label data. And then this label data is put through the supervised learning phase. So we use machine learning models based on support vector machines in particular. And once this machine is trained, this model just works real time and not just gives you the classification of any story breaking out in real time, but also a confidence value or a probability of belonging in one of the three classes. So we get a little bit more granularity than just a classification. We also get a confidence number. And this data can be consumed or generated in a few different ways. So obviously, the building block is the story level sentiment. So every story, whether it's a news story or a tweet, is put through the machine. We get the three-way confidences. But then we can further aggregate these story level data in multiple ways. We can aggregate them at the company level, or maybe at an industry level, and also at various time period levels, right? So we can look at sentiment over the last 1 hour, or maybe last 1 day, or last 1 week. So there's multiple ways to slice and dice this data for your use. So this is motivating the construction of the machine learning method. So we are essentially using support vector machines here, but with a twist. Support vector machines are designed to do binary classification, so class A versus class B. But the task that we have is classification into three categories: positive, negative, and neutral. So we are actually using three different SVMs to help with generation of the three-way classification. So we use an SVM for positive versus negative classification. We use a second SVM for positive versus neutral, and a third one for neutral versus negative. And each of these SVMs is operating in a very, very high dimensional space. And the feature space really is coming from the bag of words framework. That is a very typical framework used in NLP. We essentially have a dictionary of words which we think are relevant for financial news in particular. So that's already a big list, because we are in a very specific domain of investing and finance. So we are able to guide the choice of that dictionary itself, which will give us a good starting point. And we represent every story as a high dimensional vector in that space, and then we apply the SVMs on top of that framework. I'll just take a pause here and see if there are any questions. If the moderator can help see if there's any questions for us.
Hi, there is one question. The question is, the labels of positive, negative are from whose angle? And the second was he's asking because I would think this would depend on the perspective.
Right. So that's a very good question. So the labels are generated based from a point of view of an investor with a long position in that particular underlying. So we are basically as an annotator or a labeler, you're basically answering the question: if you are a long investor in that company, is this particular news item positive, negative, or neutral from that perspective? And it's only only based on the text in that news. So we are not using any market information. So in particular, we don't use any return information. We are not trying to bring in the performance itself as part of the labeling process, and that's a key aspect, because this is purely based on the sentiment embedded in the text. We obviously test for the performance of the stocks based on this signal as a result, but we don't use the market data or price data to help the machine learning algorithm itself, because first of all, that would be a very noisy indicator, because as you can appreciate, the prices tend to be very noisy, and secondly, it will confuse the source of the signal, which is really what we're after, is really the sentiment expressed in the story.
Okay, there is another question,
right.
which is any reason for choosing only support vector machine SVM and not any other model? And by the way, the questionnaire Aruna answers. Thank you. Carry on. I have a question afterwards.
Yeah.
Go
ahead. No, that's a very good question. We wanted the model to be somewhat interpretable. So support vector machines, they do tend to give you weights for the different words that are in the feature space. So you can sort of as an intuition check, you can go back and verify that the certain words which are supposed to have positive connotations indeed were used in a positive way, and so on. But clearly, you can try various algorithms. I know there's some deep learning work going on as well to extract sentiment. At Bloomberg, we haven't tried deep learning yet on this problem. We are very happy with what we got with support vector machines. We get accuracies in the low 90s. So that's very, and we find very little difference between the in-sample and the out-of-sample performance. That's also very, very key for us. So we get about 90 to 92% accuracy for both in-sample and out-sample.
Arun, I've got a question. Actually, another question has come. Oh, that was okay. That's great. From was it? I have a question that is, we use for daily trading, what is called adjusted closing prices, which means when you have splits and joins in the company, those are reflected and updated. Now, for the purpose of backtesting, do you also adjust your time series data for splits and joins, time series data of news?
Absolutely. I think corporate actions are all taken care of properly. So the tickers get mapped properly, backdated when you have any corporate actions. Also the price data is updated for any mergers, acquisitions, or dividends and things like that. So yeah.
No, I'm not talking about the price figures. I'm talking about the news relating to that. Because if you're doing backtesting with news, we should do the same, no?
Right. So in terms of backtesting, we want to make sure we have true point-in-time data. So if we had a company that has since been acquired by, let's say, company A acquired by company B, when we go back in the history when company A was still active, we don't want to attribute it to company B at that point. We want to still respect the fact that this was company A's sentiment, and we'll use the universe of available underlyings at that point in time, and we will not.
Okay.
We will not match.
Okay, that's good. I think we had enough interruption. You better carry on.
I should go on now. Yeah. If you can give me the controls back. Thank you. Okay, so just to set up the support vector machine, I guess many of you are probably familiar with this technique. I've represented that in a two-dimensional space here, but in general there will be a very high-dimensional space that you're working in. Essentially, we are looking for that line which is dividing the two classes of points. So think of the red as like negative stories and blue as the positive stories. And you're looking for that hyperplane W, which is going right through the middle, and you can look at the dot product W transpose X plus B. If that is positive, you are in the red zone. If that is negative, you're in the blue zone. So essentially, the sign of that dot product tells you the classification of the algo. In general, it's not an easy problem to find that optimal hyperplane. So you can see that there are multiple possible choices that are all valid, and that's where we need, optimization. And Professor Mitra, I know, is an expert in optimization himself, but there's an optimization problem behind the scenes, which is used to solve the SPM result. And to set it up, you have to define this concept of margin. The margin is defined as the distance of the nearest points to the hyperplane. So you look at the picture below, you see that there's 2 blue points and 1 red point, which are like equidistant from the hyperplane. And that distance is what we call the margin, and the aim for this optimization problem is to maximize that margin, because that will give you the most clean separation between the two classes. And I'll just leave it here, for you to appreciate that this is a convex optimization problem, which is maximizing the margin, and because it's convex, it's very tractable, even in the presence of large amount of data. So if you have, let's say, a million stories in the training data set, it's not a problem for solving this problem in a very efficient way. So without going into the details of that, so this is sort of like what happens behind the scenes when you're solving for SVMs. And what we are doing in addition is extending the concept of classification to also give a probability of belonging in each class. So if your point is far away from the separating hyperplane, then you have a better or less noisy classification, because then you're clearly in either the red zone or the blue zone. And you can code for that using a simple logistic function, which is written down here. So in the denominator, you'll see there's an exponential of kind of that margin of a particular point normalized by a sigma parameter. So essentially, if that margin of that particular point is very high, if it's going towards, let's say, high positive values, then you will get probability as being 0. If that margin or distance is going highly negative, then you'll get the probability as 1. So in both those cases, essentially, you have very clean indication of the label that you're generating for the classification. And if you're right in the middle, if your distance is 0 to the hyperplane, so basically that exponential has the argument of 0, you will get probability equal to 0.5, which means you are not confident at all in terms of what label you want to assign to that story. So this gives you an additional level of interpretation. And this is our mechanism to combine 3 SVMs into the 3-way classification. So now we put together into this sort of meta machine learning framework outputs of each of the 3 SVMs in a single framework. So each of the 3 axes is the confidence score from the 3 pairwise SVMs. and the red points are the training data stories which are negative. The green ones are the positive, and the blue are the neutral. And as you would probably imagine, they line up intuitively along the three axes, which makes a lot of sense. You know, the red stories, they score 0 on the negative versus positive, and also on the neutral versus negative. That makes a lot of sense. Similarly, you know, the other two labels. But there's some stories in the middle which seem to belong in this no man's land area, and that's where we will have noisy classification, right? So the idea of this three-way classification is to build a new machine learning model in this three-dimensional space, which will help classify into one of the three labels. So we use one of the simplest machine learning algos called the nearest neighbors to help with that. Essentially, for any target story which breaks out real time, let's say right now, it will fall in somewhere in that cube, and you will look in that neighborhood of that target story, how many of the labeled stories or the training data stories were positive, negative, or neutral, and depending on what you pick up around the neighborhood, you assign kind of the majority voting method, including actually you can actually give out a three-way probability classification using this method, which is standard nearest neighbors algorithm. I'll skip the details right now in the interest of time. We've also built diagnostic tools to further help with you know, detection of potentially problems with the training data, as well as improvements for our machine learning algorithms. So we need diagnostics tools which help us find issues either in the algorithm or in the data. So essentially, this is a confusion matrix which tells you how good the classification is. We want to see most of the points across the diagonal in the actual versus predicted labels, but we see that there are some stories which are off diagonal here, which we can sort of study further. For example, when we talk about three-way probabilities, you can actually visualize the story as a point in this equilateral triangle. If the story is 100% neutral, then it will lie on that vertex called neutral. But in general, any three probabilities which sum to 1 will lie somewhere in that triangle, and this is a good way to visualize the story level data. And for example, here we are inspecting the bottom right diagonal of the confusion matrix. So where actual and the predicted are both positive, and you can see in the triangle they lie on the bottom right as well. And we can then actually dive into the stories. We see the headlines there and see what words were contributing to the sentiment. What's more interesting here is in this slide is where we go into one of the off-diagonal entries of the confusion matrix, and we are studying the stories which were actually negative, or they were labeled negative, but our prediction was positive. And this is where we can dig deeper and find out if the labeling was wrong, for example, because humans make errors too, or if the machine learning algorithm is missing a nuance or making some wrong judgments. And we can help sort of on both the data side and the algo side to improve this process. Okay, but once all of that machinery is all settled and in production, we are able to generate sentiment data for all the companies. We cover a big universe of companies. In terms of the languages, we are currently on English only. I think we should have Japanese coverage at some point soon. But right now, in terms of stories, we are only looking at English stories. But in terms of the underlyings, we're looking at global stocks. And recently, we've also extended that to include some of the commodities as well. So we have coverage for oil, gold, maybe a couple other commodities. Anyhow, once we have this machinery in production, we can build sentiment average and sentiment dispersion. So every story, as we talked earlier, has the three-way confidence coming out of the machine, and from that we can build this polarity score, which is simply the difference between the confidence for the positive label and the difference of that with the confidence for the negative label. And this is designed to be between -1 and 1. And this polarity score can simply be averaged across a set of stories to build, for example, a daily level indicator for a company. So if you want to build an IBM sentiment for the last 24 hours, you simply collect the stories for IBM in the last 24 hours. You build a polarity score for each story, and then you average it to get the sentiment average. In the same spirit, you can also build a dispersion indicator, which is measuring the variance of sentiments in the same set of stories. It turns out there are two sources for that, what you call intra-story and inter-story. Intra-story contribution comes from, the lack of full confidence in a label for a particular story, and the inter-story comes from the temporal data or time series data, where we know that every story, as it breaks out over a 24-hour period, will have slightly different sentiment attached to it. So these two sources of variances, they combine very nicely into this total variance or dispersion metric that is an additional signal or factor that we can use for trading strategies. All right, so with that, we'll show you some results based on the sentiment data. So at the outset, we start out with a very simple analysis here, looking at correlation between sentiment and market return. So this is the same day contemporaneous correlation. So this is actually not a viable trading strategy. This is just to show that we have a lot of value in the data, so that there's a high correlation between sentiment and returns. So if you look at particularly the sentiment quantile buckets on the far side, either on the left or on the right, you see they have very high positive or negative returns. So high values of sentiment are co-occurring with high values of returns. This is obviously not tradable, but the next slide shows you a more tradable version, where we are looking at the same picture but with the next day return on the y-axis. So we see that the signal is weaker in the predictive sense compared to the contemporaneous sense, but there's still a couple of buckets on either side are highly significant. So we are plotting the mean value of the return with the confidence bars around it. So if the confidence bars are away from 0, that means your result is statistically significant. And we can see that the extreme values of sentiment does allow you to get a tradable alpha. And with that, we construct this factor strategy. We construct a long short strategy. We can go either very extreme and only look at the top 5 and bottom 5%, or something more conservative as one third on either side. And the third strategy is called proportional, which allows for not binary position in the stocks, but the position which is proportional to the sentiment itself. And we can see the results of that strategy in this plot. On the far right, you will see the performance of the benchmark itself, and you can see it's not significant because the bands are spanning the 0 value. So the index itself did not have a highly positive return, but each of the 3 sentiment strategies are significant here. You can see that the yellow one, which is the 5%, has more volatility or more dispersion. It's because it enjoys less of diversification due to positions in fewer stocks. But the 1/3 and the proportional, they actually have less variance. In the Sharpe ratio sense, all the three strategies are somewhat similar. So the point is that they are actually predictive of the return and possibly tradable. So these are some of the equity curves from that trading strategy. The top two, the highest performing ones, are actually a combination of the sentiment signal with the dispersion signal. So we find that if you combine or filter using dispersion the sentiment data, we can generate additional alpha on top of just using sentiment itself. And we see that this result is very, very significant for small caps in particular. We don't really get very good results on this for the large caps, but this is good for small caps and both for news and Twitter. And we see Sharpe ratios around 5 there, and that's actually potentially a misnomer because this was without the trading cost. I'm going to show you something with the trading cost later. After trading cost considerations, we get a lot of the alpha is washed out because these are high turnover strategies. We are changing our portfolio on a daily basis, and this shows you this particular slide shows you the power of combination of Twitter and news on top of either one's on its own. So we see that there is some sort of the two signals from the two sources of news and Twitter are somewhat uncorrelated. So when you combine them, you get higher risk-adjusted returns. So that's another idea for our clients to try is to really mine the decorrelated nature of these two signals as well. And finally, trading costs are definitely a big concern, and you'll see that many of these strategies will bleed due to trading costs. And as we apply that consideration, we see that some of the strategies don't remain profitable, but a few of them do, especially the ones which are combining news and Twitter and possibly looking at dispersion filter on top of the sentiment. So there's definitely factors which have alpha or risk premium here even after trading costs. And we have tested this data over 10 years. So this is a long-term performance of this same data. On the right-hand side plot, you'll see the long side only and the short side only are depicted on their own, and you can see that both of them perform very well. So our performance came from sort of the contributions from both the long and the short side. Especially the short side really outperformed during the crisis in 2008. And you can see that the red curve on the right having a big jump during the crisis, and when you combine them, you get the blue curve with much lower volatility. So as you combine the long and short, that's really where you get a lot of variance reduction. And this is why we prefer this data to be used sort of more in a factor trading strategy with a large universe and enjoy diversification instead of purely sort of the event level or single name level settings. Anyhow, I know we are running out of time. I'll just give you a taste of a few more things there. We showed you the factor strategies for large universes, long and short, but we can also do specific ones around earnings, for example, and these ones do perform even for large caps. So around earnings, we do find that the signal available from sentiment data is for large caps as well, and you see good performances. There's a little more volatility in these curves because there are very few earning events, and you don't have very diversified positions in your portfolio, but you actually get more value out of it in terms of large caps. And also you can look at intraday setting. If you are in a very low latency framework, you can see how the signal decays over time as the story breaks out over what happens in the last 20 minutes or the next 20 minutes. And we see the signal kind of flattening out after about 10 minutes of the story breaking. So that's something that you can study. And the intraday as well, we find good signaling power of these things. One more aspect to further incorporate for quants is to use sentiment in a risk model combination. We know that sentiment as a pure signal could be correlated to other factors, other risk factors. So you want to, if you want to really not just sort of find out the marginal or the true value of the sentiment signal alone, but as well as further ask for additional risk premium by taking out the known using correlations. You can increase the risk performances. So essentially, we look for not just the expected return in terms of the sentiment, but also minimizing the risk, which is defined using the covariance matrix or the factor model. And this construction allows us to further double the Sharpe ratio over here. Essentially, the first strategy is using just a standard sentiment signal in a long-short framework, but the second strategy is combining that with our risk model and also using sort of correlations in consideration to sort of apply proper diversification to the sentiment portfolio to achieve a better Sharpe ratio. There's also a few other ways to slice and dice this data, which could be interesting. We said that small caps have better performance from the news and Twitter data, and we can see here that the small cap bucket shows much more sensitivity on the top. We have higher slope, but we can also combine that with a different cut. For example, in terms of high trading volumes, we find that stocks which have higher trading volumes actually enjoy a better correlation with, or predictive correlation with sentiment in terms of returns. So we can actually combine those two cuts into a sort of a two-dimensional cut, and we are seeing here, a set of 9 buckets across the two cuts. We find that this zone over here on the bottom left is where we have smaller caps and high volume, and that's really the sweet spot in terms of getting the most out of this data. And finally, I'll leave you with this. We have done analysis on different sectors, and we find that some sectors show higher sensitivity to the sentiment data. For example, consumer cyclical and technology in particular, they respond more to consumer sentiment expressed in these stories. And with that, I'll end my talk. I think we can stay for some more time if we have a few questions.
Okay, we have a few questions, but let me just quickly summarize. We had a great insight to as much as we can within an hour of Bloomberg latest research. There are 2 white papers by them. One called Embedded Value in Bloomberg News and Social Sentiment Data. And the second one is called Long-Term Performance of U.S. Equity Long-Short Strategy. You could write to the speaker directly or download it and get these 2 white papers. I would also like to add that we are running actually a face-to-face seminar in London on 27 and 28 June on the topic of sentiment analysis and machine learning applied to financial markets. You are welcome to attend that, or alternatively, in case you can't, you can write to us and we'll make available to you the slides. So now, questions for Arun. Let's see. We have a question. What programming language was this done on? Is it possible to get the source code? That's from Terence Noko.
Yeah, unfortunately, the source code for this is not in the open source domain. We do our initial research work in Python. In production, in some cases we put it in C++, but slowly we are moving to a fully Python-based infrastructure, even for production coding. A lot of the work here was done on top of open source libraries, but we found that in order to make the machine learning algorithms more and more robust, we actually ended up building our own flavors of the algorithms themselves. Unfortunately, I think we have to wrap up here. We are out of time. Would you mind maybe relaying some of the questions by email, and I'll definitely take a look at them.
Okay, very good. And thank you very much for attending. And thank you, Arun, for your great presentation. Thank you.
Thank you all. Thank you all for attending.
Thank you all.
Bye now.